You know, there's a strange thing about Wall Street. Everybody wants to know what's coming next, but very few are willing to listen to what the market is already saying. The tape speaks louder than any man, but most traders don't have the patience to let it finish its sentence. And that's exactly what we're talking about today, how to predict major financial moves. If you remember the previous video on signs that a trend is about to begin, you'll see this is the next step in the same study. Back then, we talked about catching the spark. Today it's about seeing the fire before the crowd smells the smoke. Now, let me tell you something I learned early on. The market doesn't hide its intentions. It whispers them, softly, through price action, through volume, through the behavior of men who are too sure they know better. You just have to learn the dialect. You ever look at a chart and feel like something's shifting beneath the surface, but you can't quite say what it is? That's your intuition talking, the part of your trading mind that's developed from thousands of hours of watching the market breathe. Never ignore it, but never trust it blindly either. The market demands proof, and it gives it in its own time. See, the major financial moves, the ones that make and break fortunes, they don't arrive out of thin air. They build slowly, like pressure under the earth. Prices consolidate, volume dries up, and the public grows bored. That's when the professionals are busy. They're quietly taking their positions while everyone else complains there's nothing happening. Then, when the move starts, the crowd rushes in, late as usual. By the time they're convinced, the insiders are already selling to them. Doesn't that sound familiar? When I study a stock, I never ask myself why it should move. The why belongs to the newspapers. I look for when. Timing is everything in speculation. The man who buys right but too early is just as wrong as the one who buys late. So, I watch for the market's telltale signs, the small but consistent clues that a big move is brewing. A narrow trading range after a long decline, for instance. That's often the market catching its breath before a turn. Or when a stock refuses to go down on bad news. That's strength, my friend, quiet strength. You see, predicting a financial move isn't about fortune telling. It's about pattern recognition. The human mind craves certainty, but the market only offers probability. So, what do? We train ourselves to see recurring behaviors, the footprints of big money. When a move begins, it's not the small trader who creates it. It's the large operators, the ones with resources and patience. If you can learn to spot where they're moving in, you'll stop following the crowd and start following the leaders. Let me ask you, how many times have you bought because you felt the price was too low, only to see it go even lower? Every trader's been there. The truth is, the market doesn't care about what feels cheap or expensive. It only cares about what's being accumulated or distributed. That's why you must learn to read the tape without emotion. Prices are never too high to buy, nor too low to sell, if the conditions are right. The market tells you what it wants to do. Your job is to obey, not argue. Now, remember in that earlier video about signs that a trend is about to begin, we talked about momentum shifts and the early tremors that hint at a breakout. What we're discussing today is how to connect those tremors into a map of probability, how to sense when a small ripple can become a tidal wave. Because predicting a major financial move is not about predicting direction alone, it's about understanding commitment. Are the big operators committed? Are they quietly building a campaign? The chart will show it, if you know what to look for. When I traded in my early years, I used to think that I had to outsmart the market. I wanted to find secrets others couldn't see. But the truth is, the market's secrets are plain as day. They're just ignored because they seem too simple. Take volume, for instance. When a stock advances on strong volume, pauses, then continues with less resistance, that's confirmation. When it declines with light volume and suddenly spikes down with heavy selling, that's exhaustion. Each move, each hesitation, tells a part of the story. Are you reading it, or just watching it happen? Every great move I've ever caught began long before the newspaper caught on. By the time the world is talking about it, the best part of the move is already done. The professional buys when the chart is quiet and sells when the crowd grows loud. That's human nature. Most men are only comfortable moving with the majority, but markets reward the minority that acts before the crowd sees the light. So, the next time you feel the urge to jump in because everyone's talking about a can't miss opportunity, pause. Ask yourself, who's selling to me right now? There's another thing, and I want you to take this seriously. Predicting a move isn't just about the chart. It's also about your capital, your mindset, and your patience. A man can be right about the market and still lose money if he can't sit tight. The real skill isn't just finding the entry. It's holding your position through the noise. The market will test your nerve at every turn. Can you stay calm when prices wobble? Can you resist the urge to grab a small profit when a big one's still unfolding? Because, in the end, the big money is not in the buying or the selling. It's in the waiting. You might think you need 100 indicators or some secret algorithm to spot these moves. You don't. All you need is a clear eye and the discipline to watch without bias. The market paints a picture every day, but most traders are too busy arguing with it to see the image. Try listening instead. Watch how price reacts at key levels. Note the rhythm, fast, slow, hesitant, decisive. That's the heartbeat of the market, and it never lies. Now, here's something I've noticed after years of trading. Every major move begins with disbelief. The public refuses to believe the turn is real. They call it a temporary correction or a short-term rally. Only when the move is nearly done do they finally believe. And that's when the professionals quietly exit. It's almost poetic how predictable human behavior is. That's why studying market psychology is just as important as studying charts. The two are inseparable. A chart, after all, is just a picture of collective emotion over time. So, when you think about predicting a major financial move, think less about predicting the future and more about interpreting the present. The future lives inside the present, just as the next move lives inside the current pattern. Learn to read those patterns like a detective reads clues, not like a gambler guesses odds. Every top, every bottom, every breakout. Each has a rhythm, a sequence, a build-up. Once you see it clearly, you'll realize the market's biggest moves are rarely surprises at all. Predicting moves is about probability, not certainty. That single idea separates the professional trader from the dreamer who gambles on hunches. The market never guarantees anything, and the moment you start believing it should, you've already lost. You see, too many people come to Wall Street looking for sure things. They want a formula, a magic combination that tells them what's going to happen tomorrow. But the market doesn't deal in guarantees, it deals in odds. Your job as a trader is to understand those odds and position yourself where they lean in your favor. Think about it like this. Every price movement is the sum of countless human decisions. Fear, greed, hope, hesitation, all mixed into a single quote. How could anyone ever be certain about what that collection of emotions will do next? But what you can do is recognize recurring behaviors. The market, for all its complexity, is built on the repetition of human psychology. Fear always looks the same on a chart, and so does greed. Once you've watched enough of it, you begin to see probabilities instead of predictions. You learn to say, this setup tends to produce this kind of outcome, instead of, this is definitely going up. The amateur wants to be right, the professional wants to make money. That's the difference. I've seen countless traders destroy good positions because they couldn't accept uncertainty. They needed to know what was going to happen, and when the market didn't confirm their expectation immediately, they panicked. You can't force the market to validate your belief. All you can do is operate with the best information available and accept that even the best setups fail sometimes. A successful trader doesn't need to be right all the time, just right enough when the odds are in his favor. You ever notice how the crowd behaves after a major move? When prices start climbing steadily, the public gets more confident with every tick upward. They begin to believe the rise will never end. Then, at the top, when the probabilities have turned, they still can't see it. They're blinded by certainty. That's what probability trading protects you from. It keeps you humble. You stop predicting. You start preparing. You don't marry your opinions. You You date your trades. You're willing to be wrong because being wrong is part of the business. The market speaks in signals, not certainties. A breakout above resistance with strong volume is a signal, a suggestion that demand is stronger than supply. But it's not a promise. A reversal pattern at the bottom of a long decline hints that selling pressure might be exhausted. Again, not a guarantee. The man who understands probability treats these signals as evidence, not prophecy. He builds a case for action the way a detective builds a case for guilt. Carefully, with proof that can still be challenged. The moment you attach certainty to a trade, you attach emotion. And emotion clouds judgment. You start defending your position instead of analyzing it. That's when the market punishes you. Every great trader I've known accepts uncertainty as the price of admission. We don't control the outcome, we control our reaction. We control how much we risk, how we size our positions, and when we step aside. That's what probability-based thinking really means. It's not about predicting, it's about managing. Let me ask you something. When was the last time you took a trade knowing it might fail and still felt calm about it? That's the mental balance you need. Because if you've done your homework, if you've read the chart, understood the market context, and sized your risk properly, then a losing trade is just another statistic in the larger sample of your process. You're not shaken by it because you know no single trade defines your success. That's how professionals think. They trade the law of large numbers, not the outcome of one roll of the dice. When you shift your mindset from prediction to probability, you also free yourself from the constant emotional roller coaster of needing to be right. You begin to think like an investor in odds, not emotions. Each setup becomes a business proposition. If I take this trade 10 times under the same conditions, will it make money overall? That's how systems are built, how confidence is earned. It's not in calling the top or bottom. It's in consistently executing where the math favors you. Remember what we discussed back in the video about signs that a trend is about to begin. How the early signs don't confirm a trend, but they hint at one. That's the essence of probability thinking. You're not claiming to know, you're identifying a likely scenario and positioning yourself to benefit if it unfolds. That's what separates speculation from gambling. Gambling is guessing without evidence. Speculation is reasoning with uncertainty. In trading, the best you can ever do is stack probabilities in your favor. You might have a setup that works 60% of the time. That's not perfect, but with proper risk control, it's enough to build wealth over time. The trick is to keep your losses small when the 40% happens. A trader who understands probability doesn't chase perfection, he chases consistency. He accepts that losing is part of winning, just as drawdowns are part of growth. Think about how a casino operates. It doesn't need to win every game. It just needs to maintain an edge, no matter how small, over a large number of plays. That's how it makes money, and that's exactly how a trader should operate. You build your edge through discipline, experience, and pattern recognition. Then you apply it relentlessly, without emotional interference. Over time, the law of probability rewards consistency far more than brilliance. The dangerous thing about certainty is that it tricks you into oversizing your trades. When you're sure about a move, you bet too heavily, and when it goes against you, you're left without defense. The professional never allows that. He sizes every trade based on risk, not confidence. The market can make a fool of anyone at any time, and humility is the best insurance. Confidence in your process, yes. Certainty about your predictions, never. Once you start thinking in probabilities, the entire market looks different. You stop asking, will this go up or down? And start asking, what's the most probable direction given the evidence? You stop reacting to every tick and start focusing on setups that align with your plan. It's not about being psychic, it's about being patient. The market rewards patience with clarity, but it punishes certainty with ruin. Most traders fail not because they can't analyze charts, but because they can't accept not knowing. They crave control in a world that doesn't offer any. The truth is, control in trading comes only from preparation and probability, never from prediction. The market moves where it wants, when it wants, and all we can do is listen, interpret, and respond. Once you accept that uncertainty is permanent, you stop fearing it and start using it as an ally. Strength or weakness often shows in how prices react to news. That's a truth most traders learn too late. The market doesn't move because of the news. It moves because of how people react to it. Every day, headlines shout about earnings, inflation, wars, mergers, or rate cuts. But the tape, the pure movement of price, tells you something far more valuable: how the market feels about that news. And that feeling is where the real story hides. You see, news itself is neutral. It's just information. But the way prices respond to that information reveals the underlying strength or weakness of the market. If bad news hits and prices don't drop much, that's not a coincidence. That's strength. It means the selling pressure has been absorbed, that the strong hands, the professionals, the big operators, are quietly taking in what the public is throwing away. On the other hand, if good news comes out and prices barely rise or, worse, start falling, that's weakness. It means distribution is happening behind the curtain while the crowd is still cheering. This is something I've watched happen time and again. In my early trading days, I used to think that following news would make me sharp, that I'd be ahead of the market. I'd read every bulletin, every report, and I'd rush to buy or sell before anyone else. But what I didn't understand was that by the time the news reached me, it had already been acted upon by those who knew before it broke. The professionals trade on expectations. The public trades on reactions. That's why watching how prices behave after the news is far more important than the news itself. Let me ask you, how many times have you seen a company announce record profits, and yet the stock drops the next day, or a disappointing report comes out, but the price barely moves? That's the tape talking. The market was already prepared. Prices often anticipate news long before it's published, because the smart money positions itself early. By the time the headline hits the paper, the real move is already done, or just beginning to reverse. You can't trade the news, but you can trade the reaction. That's where the edge lies. For instance, when the market absorbs bad news and refuses to go lower, it's a sign that selling is drying up. That tells you the downtrend might be near exhaustion. The professionals aren't dumping anymore. They're quietly accumulating. That's strength. It doesn't shout. It whispers. You have to train your eyes to see it. The opposite is just as telling. When every piece of good news sends a smaller and smaller rally, that's distribution. The insiders are using optimism to unload their positions on the latecomers. Think back to what we discussed in the previous video, signs that a trend is about to begin. We talked about how early trend signals often show up, not in the headlines but in subtle market behavior. This principle ties right into that. When prices start reacting less to bad news and more to good news, you're seeing the early stirrings of strength. When they start ignoring good news and collapsing on the smallest disappointment, weakness is already spreading beneath the surface. A strong market behaves like a man with quiet confidence. It doesn't flinch at rumors. It shrugs off fear. It climbs walls of worry while the public hesitates. A weak market, on the other hand, trembles at every whisper. It breaks on the slightest pressure. The trick is not to predict what the next news will be, but to observe how the market digests what's already out there. Does it rally on bad headlines? That's a sign of demand. Does it sell off after good ones? That's a warning bell. The reason this works is simple. All news is filtered through human emotion, and the emotions of the crowd lag behind the movements of professionals. The insiders have already seen what's coming. They've acted on it. The public, on the other hand, reacts late, and that reaction creates opportunity for the observant trader. That's why I always say never listen to what the market says. Watch what it does. You ever notice how at major market bottoms, the headlines are filled with fear? Analysts warn of further collapse, investors swear off stocks, and yet, quietly, prices start to rise. The market starts to rally in the face of bad news. That's not luck. That's strength building under despair. It's the professionals stepping in while the crowd is paralyzed by emotion. The same thing happens in reverse at the top. Optimism fills the air, forecasts turn rosy, And yet, prices start struggling to advance. Every piece of good news becomes a selling opportunity for those who know the music's about to stop. This is why a trader must learn to separate information from interpretation. The tape doesn't lie, but opinions do. When you see a market shrug off negativity, you're seeing confidence in action. When you see it crumble on optimism, you're witnessing fragility. The crowd doesn't notice these shifts until it's too late, because they focus on the story instead of the behavior. But the trader who reads reactions instead of headlines always stays a step ahead. Let me tell you something else. Timing matters. The first reaction after news can be emotional, a quick burst of buying or selling by the crowd. But the second move, the one that follows after the dust settles, that's the real signal. If, after bad news, the market recovers quickly and holds those levels, you're looking at genuine strength. But if it fades after good news and fails to hold gains, weakness is still in control. Always wait for that second act before making your judgment. Price behavior around news events also shows you where the smart money sits. For example, if a stock gaps down on bad news but then closes near the top of the day's range, that's buying pressure stepping in. Someone's accumulating quietly. But if it gaps up on good news and finishes weak, closing near the lows, that's selling, plain and simple. Those are the fingerprints of professionals, and they're visible to anyone who learns how to look. Understanding how prices react to news isn't about ignoring fundamentals. It's about seeing them through the lens of behavior. Fundamentals tell you what should happen, price tells you what is happening. The two don't always match. When they don't, trust the price. The market, in its cold logic, is always ahead of the story. Once you train your eyes to observe these reactions, you stop being surprised by big moves. You'll see them forming quietly as the market tests the crowd's belief. Each overreaction, each muted response, tells you who's in control, the professionals or the public. And when you can answer that question with clarity, you can position yourself on the right side of the move long before the headlines catch up. The future of a move is hidden in the present price action. That's something every serious trader eventually comes to understand. You don't need to know tomorrow's news to see where the market is heading. You just have to study what it's doing right now. The chart, the tape, the rhythm of price and volume, those are the footprints of the future. The market doesn't change direction out of nowhere, it leaves clues, subtle and consistent, in the present moment for those who are watching closely enough to catch them. Every move, big or small, begins long before it becomes obvious. The public only sees it once it's already well underway. But the professional, the tape reader, recognizes the signs early because he's trained to see the story developing in real time. When you study price action, you're not looking for certainty. You're looking for evidence. The market tells you everything you need to know. The trouble is, most traders are too busy predicting to notice. They're trying to jump ahead, guessing where prices should go, instead of reading where they're already going. You see, price action isn't just a line on a chart. It's a living conversation between buyers and sellers. Each bar, each tick, each volume spike is a word in that conversation. If you learn to listen, you'll understand when strength is building, when weakness is creeping in, and when momentum is shifting. The future move, whether it's a breakout, a reversal, or a collapse, is born in those quiet changes before the crowd notices. Let me ask you, how often have you seen a market move suddenly, and everyone calls it unexpected? The professionals never find it unexpected. They saw the build-up days or weeks in advance. They noticed the higher lows forming quietly, the tightening ranges, the increase in volume without much progress, the way bad news stopped pushing prices lower. These are all signs that something is brewing beneath the surface. The market always reveals its intention. It just does it in whispers, not shouts. That's why observation is the most valuable skill a trader can develop. Not analysis, not opinion, pure observation. Watch the price act. Watch how it reacts at certain levels. Does it hesitate where it once broke easily? Does it surge through resistance with conviction? Does volume confirm or contradict the move? Every one of these details tells you something about what's coming next. The future is not hidden in mystery. It's hidden in plain sight, inside the present. You might remember in our earlier talk about signs that a trend is about to begin. We explored how early behavior hints at the direction of new momentum. This idea grows directly out of that same principle. The start of any trend doesn't appear from nowhere. It's built from the tension inside current price movement. The consolidation, the indecision, the false breakouts. All of that is the groundwork for the next big move. The trader who learns to read those early shifts will always seem lucky to the crowd, but it isn't luck, it's preparation. The market in many ways is like a living organism. It breathes, it contracts, it expands, it pauses. When it's tired, it moves slowly. When it's ready, it explodes. Price action captures those cycles perfectly. For example, before a strong uptrend, you'll often see a pattern of quiet accumulation. Higher lows forming under steady volume, resistance being tested repeatedly, sellers gradually losing their strength. The future uptrend is already there, waiting to break loose. The same goes for tops. Distribution happens quietly, not in a single day, but over many sessions. Prices stop advancing on good news, volume grows heavy, and the market starts reacting badly to strength. The decline is still invisible to the public, but it's already unfolding in the present. If you can learn to interpret these behaviors, you'll stop chasing moves after they happen and start positioning yourself before they unfold. The future is just an echo of what's happening right now, magnified over time. That's why every serious trader keeps his eyes on the present, not his hopes on the future. The present is where the truth lies. The future only reveals what was already in motion. You ever notice how certain stocks or markets start acting different before a big move? They don't break out immediately, but their character changes. They stop falling on bad days. They start holding higher levels. They trade with more energy. That's not random. That's accumulation. The big operators are moving in quietly, and the tape is reflecting their activity. The same thing happens before a drop. Prices grow heavy, rallies fade faster, and the market can't hold gains. The public calls it uncertainty, but it's really the start of a turn. The future move is being written line by line in the present price action. When you understand that your entire approach to trading changes, you stop reacting and start anticipating, not by guessing, but by reading. You become less emotional, less impatient. You wait for confirmation in the behavior of price itself. The market doesn't care what you think should happen. It only cares about what's actually happening. That's why the best traders spend less time forecasting and more time observing. The chart is the truth teller. Everything else is noise. The beauty of price action is its honesty. Indicators can lag, opinions can mislead, but price is immediate. It reflects every hope, fear, and calculation happening in real time. When you see a level tested repeatedly, that's the market building energy. When you see volatility shrink after a long decline, that's exhaustion setting in. When you see a sudden surge of volume after a quiet phase, that's attention returning. Each of these signals points forward, hinting at what's about to unfold. The trick is to interpret them without emotion and act with discipline. You don't have to predict the future if you can recognize its reflection in the present. That's what professionals do. They don't need to guess. They watch, they wait, they act when the evidence aligns. The future move, whether it's a rally, a crash, or a reversal, always leaves its fingerprints in today's behavior. The higher highs, the failed retests, the shrinking reactions, the way volume behaves near key points. Each one is a message from the future, written in the language of price. Most traders overlook this because they want the thrill of prediction. They want to be the first to call the next big move. But the market doesn't reward loud predictions. It rewards quiet accuracy. You don't have to see far ahead, just far enough to recognize that the next move is already beginning under your feet. The man who studies today with clarity will always know more about tomorrow than the man who guesses blindly. The future doesn't arrive suddenly. It's already here, disguised as the present. The market shows it in every tick, every hesitation, every surge of energy that others dismiss as noise. Once you understand that, you stop chasing shadows and start trading reality. You stop hoping for signals and start seeing them. You realize the next move, the next opportunity, the next turning point. It's not coming later. It's already taking shape right now in the living language of price. Quiet accumulation periods precede explosive trends. That's one of those truths that never gets old, no matter how many decades pass. Markets may change their instruments and technology, but human behavior never changes. An accumulation is simply the expression of patience by those who know what's coming. It's the calm before the storm, the silence before the orchestra begins to play. Most traders overlook it because nothing exciting seems to be happening, but that's exactly why it's so important. The professionals love quiet markets. They're where the real money is made long before the crowd shows up. During accumulation, prices move in tight ranges. There's no drama, no headlines, no sudden surges. Volume tends to contract, volatility falls, and interest fades. The public grows bored and walks away. They say, "There's nothing going on with this stock," and they look elsewhere for excitement.